All right, today we are jumping into one of the most powerful, most time-tested tools in any trader's playbook, the MACD indicator. We're talking about a fundamental way to understand market momentum, which is really just the speed and the strength behind a price move. And trust me, by the end of this, you'll know exactly how it works.
And you know what? That's not an exaggeration at all. This thing was developed by Gerald Apple way back in the late 70s, and it has stayed a favorite for decades for one very simple reason. It just works. Its whole job is to help you spot major shifts in a trend, and today we're going to break down exactly how it does that.
So what's the big deal? What makes the MACD so special? Well, it was actually designed to solve a classic trading problem. Do you go with a super fast indicator that might, give you a bunch of false alarms? Or do you pick a slow one that gets you into a trend way too late? The MACD tries to find that perfect sweet spot right in the middle.
Think about it like this. On one hand, you've got lagging indicators, like moving averages. Now, they're reliable for sure because they confirm what's already happened, but they trail behind the price, which means you could miss a huge chunk of the move. Then, on the other hand, you have leading indicators, like the RSI. They try to predict what's coming next, but they can be jumpy and give you a lot of false signals. The MACD, it was built to find that perfect balance, to be smooth enough to be reliable, but fast enough to help you catch the biggest, most important part of a trend.
Okay, so to really get how this thing works, we've got to pop the hood and see what's inside. Let's break down its three core components piece by piece.
First up, you've got the MACD line itself. This is the absolute engine of the indicator. It's calculated using two different moving averages, specifically exponential moving averages, or EMAs. Now, all you really need to know is that an EMA gives more weight to the most recent prices, so it reacts faster. I want you to picture the shorter 12-day EMA as a speedboat. Zippy, it reacts quickly to price changes. And the longer 26-day EMA? That's our oil tanker, slow and steady. The MACD line simply shows you the distance between the two. When that speedboat starts pulling way ahead of the oil tanker, it's telling you momentum is picking up big time.
Next, we have the signal line. Now, this is interesting. This line doesn't track the price of the asset at all. Instead, it tracks the MACD line we just talked about. It's basically a smoothed-out 9-day average of that first line, and its entire job is to be a trigger. When our faster MACD line crosses over this slower signal line, boom, that's a potential signal that momentum is about to change.
And the last piece of the puzzle is the histogram. Honestly, this is just a super simple visual aid. It's those vertical bars that show you the distance between the MACD line and the signal line. It gives you an instant at-a-glance picture of momentum. When the bars get taller, momentum is accelerating. When they start getting shorter, momentum is fading. It's a really simple but really powerful way to see the strength of a move.
All right, so we've got all the parts on the table. Now for the fun part. Let's put them together and see how they actually generate real trading signals.
So there are two main signals you're going to be watching for. The first, and the one you'll see most often, is the signal line crossover. This is your faster, more aggressive signal. It's basically telling you that momentum is shifting right now. When the MACD line crosses above the signal line, you'll see the histogram bars flip from negative to positive. That's a bullish signal. The second one is the centerline cross. This is when the MACD line itself crosses that zero line. It's a slower signal, but it often gives you more confirmation that the entire major trend has shifted from bearish to bullish or the other way around.
Okay, theory is great and all, but let's bring this down to earth. Let's look at a real-world example using India's Nifty 50 index to see how this actually plays out. Let's walk through this step by step. So, in the beginning, imagine the Nifty 50 has been in a bit of a downtrend. The faster 12-day average is at 59.20, which is below the slower 26-day average of 59.50. That gives us a negative MACD value of negative 30, confirming the downtrend. But then, the market starts to rally. Buyers step in. Our speedboat, the fast average, quickly shoots up to 60.50, crossing above the slow oil tanker, which is now at 6,000. That flip gives us a positive MACD value of plus 50. And that right there is our bullish crossover signal. Now, as the uptrend keeps going and prices climb higher, the gap between the two averages gets wider and wider. Our MACD value jumps all the way to plus 200, showing that the upward momentum isn't just there, it's getting stronger. Okay, so this is super important. Like any tool, the MACD has its strengths and its weaknesses. Understanding the rules of when to use it, and maybe more importantly, when not to, is really the key to using it well.
These rules are absolutely critical, so let's really nail these down. First and foremost, the MACD is a trend-following tool. It confirms momentum. It doesn't predict the future. That means it works beautifully in markets that are clearly trending up or down. But in a choppy, sideways market where prices are just bouncing around aimlessly, that's where it can fall apart. It'll generate tons of false back-and-forth signals. We call them whipsaws, and they can be incredibly frustrating. Also, you gotta remember, it's a lagging indicator. By the time it flashes a signal for a new trend, a good chunk of that move might have already happened. Its job isn't to get you in at the absolute bottom, it's to help you catch the big, juicy middle part of the trend. And that's exactly why you should always combine it with other tools for confirmation.
And really, that's the key takeaway here, isn't it? The MACD is an absolutely incredible tool for spotting these big shifts in momentum. But at the end of the day, any tool is only as good as the person using it. The real skill isn't just reading the squiggly lines on the indicator, it's about reading the overall market to know when this powerful tool is actually going to be effective.